Good morning. Welcome to Stock Market Today. It's Tuesday, March 10th, 2020. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at Dan Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Get a lot of the content for this show, as well as daily stock ideas for you to consider in your inbox every trading day before the market opens. So we're going to call today the day after U.S. equities were sharply lower in Monday's trading, ending near the worst levels of the day, actually tripping a circuit breaker to pause trading after a 7% decline just after the opening. The oil sell-off on the Saudi price war and the continued downbeat coronavirus headlines kept stocks under pressure. All sectors were lower on the day. Treasuries extended their rally, a ferocious rally in treasuries. Dollar was weaker on the major crosses, in particular against the yen, which is a safe haven currency. Gold finished up 20 basis points, and WTI crude closed down 24.5%. As we get to the desk this morning, though, getting a little bit of a turnaround Tuesday relief rally as S&P futures actually went limit up 5% on the morning after suffering their biggest one-day decline since the global financial crisis. Asian equities were higher overnight. European markets are seeing big gains. Treasuries are under pressure and the curve is steepening. The dollar is stronger on the major crosses. Gold down about 1%, and crude oil snapping back up about 10% on the day. Let's take a look. The S&P 500. We held above that lower support line that I drew for you yesterday after circuit breakers were hit on a large down day. Resistance is in the zone between 3,000 and 3,100. What I will say is this, for those of you keeping track at home, a 50% retracement of the entire leg lower gets you to just above the 200-day moving average here at about 30.60. So think about how fast, how violent this move to the downside has been, as your 50% retracement is now over 300 points higher, right? That would be about a 10% rally from here. RSI is oversold, a possible bullish divergence in play, and Chaikin money flow is neutral. So expect two-way volatility, right? Just expect it. We're going to take a look at a chart a little bit later in the show that points to odds favoring a retest, and we'll be looking for less intensity on that retest. Turning now to our market in a minute. What are we writing about today in our notes to Chaikin Analytics clients? Well, we're asking the question, was that the low or simply a low? And if you can answer that question, you'll be well ahead of everybody else because nobody really knows the answer, but we'll look at some signs. Stocks fall the most since the financial crisis. We hit on that. Oil plunges 25%, dragging energy stocks lower still. Folks, you've heard me here for months telling you to stay away from energy. If you tried to go bottom fishing in energy, I can't say we didn't warn you. Safe havens explode to the upside on a relative basis, and futures do point to a higher open here today. Taking a look now, major markets from a power bar perspective. I mean, folks, look at the carnage. I mean, that's utter carnage. And if it's hard for me to think that that's the ultimate low, right? I can't see how you could make the bottom your base case. Could it happen? Yes. Is it the high probability event? I don't think so. We'll look at why a little bit later on in the show. I do think you're going to see some violent oversold bounces here, though. Dow down 7.9%, 0 bulls for 5 bears. S&P 500, this is one of the lowest numbers I've ever seen here. 7 bulls for 118 bears after a 7.7% decline. NASDAQ was a slight outperformer yesterday. Only down 6.9%. 4 bulls to 23 bears, and your small caps continue to lag the broader market. 58 to 487 bulls to bears on the small caps. Bonds rip higher, 2.7%, sending yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bearish. Major markets are mixed. Stock of the day today. Now, you've heard me talk for the past week or so about how Chinese tech has held up relatively well. So I love the fact that our auto-generated stock of the day is JD.com. Internet and direct marketing retailer closed at $39.69 yesterday, down 5.86%. Now, what I will say is down 5.86% was a massive outperformer. Very bullish stock due to very strong earnings performance, very strong price volume activity, as well as attractive financial metrics. JD is very bullish. One of the few stocks still above a rising long-term trend line. Industry group is weak. Most of the industry groups are weak. But if you are looking for names that have held up during the downturn, if you are looking for names that could be leaders coming out of this, should we start to build a base and begin to work higher, JD.com is one of your names. Look at this relative strength. Holding strong through the worst of the drop on a relative basis. I mean, outperformed by nearly 2% yesterday. That's monster. Very bullish stock, outperforming, bullish money flow, neither overbought nor oversold for the time being. But I think if you're looking for names that could be leaders coming out, you got to be focused on these Chinese tech stocks. Look at CQQQ and drill down on its holdings. Look for the very bullish and bullish stocks that have held up well with good money flow. Those are likely leaders when and if we do turn. I think you want to take a look at JD. Now, likely going to snap higher here this morning, just to give you a slight indication of that. We'll take a look at where JD is trading here in the pre-market. JD in the pre-market trading up 2.73%. Right, so potentially an opportunity out there. Taking a look at our sector tracker now, movement over the last 5 days. We are back to all red, down across the board. I think it goes without saying that the top 4 are your defensive sectors, right? We've been talking about it for a while. You've had time to be positioned properly, right? We started talking about not quite being oversold yet, our notes to clients back in late February and waiting for opportunities. And we've been highlighting every Tuesday, we highlight the leading areas of the market from a sector rotation standpoint. I'd say the only thing where we were probably overly bullish and got hurt was tech. Right after that, we've been highlighting this for some time now. Ute Staples Healthcare reached the top of the list. Discretionary comms, materials, and tech are middle of the road. Industrials, financials, and energy. Look at the carnage in financials. That's rates. Look at the carnage in energy. This is why relative strength is so important. Because, folks, those trends are not new, right? Investors didn't wake up yesterday and say, we're going to take energy stocks down on a relative basis. That trend has been in place for 12 months or more. There has been no reason to touch energy for more than a year. There hasn't been a reason to be excited about financials since the beginning of January, when rates started to roll over again and relative strength in the fin started to deteriorate. We didn't wake up yesterday and decide this, folks. Trends have been in place. Our industry in focus, innovative tech services, which over the past 6 months has been an outperformer, right? Skirt to the relative strength, skirt to the alpha, up 6.73% over the past 6 months, outperformance. However, the ratio is weak. All the ratios are weak. 6 bulls to 41 bears, very weak. But it's currently ranked number 5 of 21 subsectors, having moved up 4 slots over the past week. Roku, Coupa, and Snap are the names you want to avoid in this group. But there are opportunities out there. What I would do is, if you're using Chaikin Analytics or if you're taking the 14-day trial, look at the bullish and very bullish stocks, but also look at the neutral plus stocks, because there will be your opportunities. XITK, neutral rating, trend weak, below the declining trend line. I get it. What we're interested in is relative performance, right? If we're going to rally, who's likely to lead? Well, those who held up the best. And same story, folks. We're back into this consolidation zone that marked trading for a lot of 2019. But we are oversold with bullish money flow. Wouldn't be surprised to see a snapback rally today, but I can say that with the benefit of seeing the futures up big. But I'm thinking more in terms of strategically where I want to look for ideas. If the market rallies and then retests yesterday's low, and that retest is less intense in nature, you're going to want to be ready with ideas. Look in this area. This is where you should be focused. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers, the best area in retail were the auto parts retailers. AutoZone up 5%. On a day when the S&P 500 was down 7.5%, I want to pay attention to the stocks that were up. AutoZone up 5%. Dollar Tree, 52-week high as the staples rip higher. Dollar Tree is a very bearish stock. COG, Cabot Oil and Gas, caught an upgrade from Merrill Lynch. Bank of America Merrill Lynch. Sent that stock higher by 3.14%. AAP, Advanced Auto Parts, up nearly 2%. Again, auto part retailers had a strong day yesterday. Maybe there's a thesis out there that if we were going into a recession, you're not going to get a new car, so you'll have to buy parts for your old car. I don't know. I didn't see anything company specific to drive those stocks, but I want to pay attention to what holds up on big down days. H&R Block, nothing company specific there, but it is tax time. HRB up 1.7% yesterday. Loser side of the board, I don't know how to say it other than absolute disaster, maybe utter carnage across the board in the energy complex. Don't think it can't happen, folks. That downtrend has been in play. I was laughing last week when somebody pitched me an energy idea because it had a 6% yield. Imagine you bought a stock that had a 6% yield and then it was down 30% in one day. That's 5 years worth of your yield gone. I'm not saying you should ignore stocks that have a yield. I'm saying you should combine it with relative strength work and combine it with power gauge ratings on the ETFs. What gave me the sense that I should ignore the energy pitch on the yield play? Energy's been bearish. We've been very bearish on it. It's in a downtrend, both on an absolute and relative basis. Imagine you bought a 6% yielder and woke up yesterday and found that your 6% yielder was down 30%. All right, let's dive into the charts now. Large down days. I want to talk about it. We were down 7.6% yesterday on the S&P 500. And I realize that this box is going to be a little annoying, but bear with me. I looked at other instances of large down days by using stockcharts.com rate of change tool. Set the rate of change to 1 and go back, to the late 2007. And you can see all the big down days. And what jumps out at me is when you see these outliers to the downside like this, like even here, and obviously back in 08, 09, the initial outlier is not usually the ultimate low. Okay? Even back here, yeah, we had a V-shaped recovery off the bottom in December 2018, but the initial outlier event was in October. Right? Back here in early 18, the initial outlier event was early in the year. We retested. Right? Go back in time, right? Go into stock charts, pull up the S&P 500, set an indicator for rate of change to 1 day and go back and look and notice that the outlier event is normally the initial low, not the ultimate low. I'm not saying it can't be different this time. Obviously it can be, but this is why I say your base case should not be the V, because even in late 18, it wasn't a V. It was a V in December. But the outlier lows were in October. The outlier down day was in October, right? Then we were choppy below the moving averages until the waterfall decline in December. So just keep that in mind. Healthcare is one of our best sectors. I like the healthcare group. I've been talking about it for a while, right? Look at that breakout on a relative basis, breaking topside through resistance above the 200-day moving average on a relative basis after a series of higher lows for the RSI. Now overbought, so don't necessarily want to chase, but one of the better areas of the market as far as I'm concerned. XLV has a neutral plus rating, 4 bulls to 4 bears. I think you want to be paying attention to healthcare. Take a look at the healthcare group. Look for ideas there. Finally, a parabolic move in the treasury products. Here's TLT, the 20-year plus ETF. Folks, this is a parabola to the upside. We have the potential for an island reversal here as we are actually gapping lower here this morning. I realize some folks might want to think about safety. The time to think about safety was a couple of weeks ago on the breakout. I don't necessarily think you want to be chasing treasuries into a parabolic move here just yet. Give it some time to digest. That's going to wrap us up for today. Head over to ChaikinAnalytics.com/test drive. Sign up for that free 14-day trial. Have a great Tuesday, everyone. I'll be back with you tomorrow.